The following pre-recorded program is sponsored by Adams Financial Concepts. Welcome to About Money, a different approach to investing you won't hear anywhere else. Your host, Mike Adams, is a registered investment advisor and works with investment portfolios exceeding over $100,000 in net worth and has a proven track record of managing long-term investments, surpassing the markets in the long term. The information shared on the following program is for educational purposes only, and any investment advice given may not be suitable for all investors. And now, here's Mike.
It is Saturday, and we're going to be talking about money. I'm going to continue the series. I've started a series on the question, is COVID the Pearl Harbor moment of our lifetime? I think there's a lot of ample evidence that shows the changes that will be coming in technology, in lifestyles, in demographics is going to be very similar to the changes we saw in terms of technology, lifestyles, and demographics. Those changes that came following World War II and technologies that were developed sometimes before, sometimes during the war, but it had a significant impact on what was going on in lifetime. Also today, you're going to hear from Chris Yand, who is one of Adams Financial Concepts Rising Star Advisors. He's going to share a general look at trading. So if you're managing your own money, or even if you've got another financial advisor, you should be really interested in what he has to say. He's going to tell you about the competition. He's going to tell you about the good and the bad. So you want to hear what he has to say. But I'm going to begin. I'm going to begin with this whole idea. Is COVID the Pearl Harbor moment of our lifetime? I say that, and let me repeat some of what I said last week, because Pearl Harbor, the beginning of World War II, was a significant change in technology, demographics, and lifestyle. The changes were dramatic. Think about it. Developing the atomic bomb, yes, we developed the bomb, but that gave rise to the changes we've seen in nuclear applications, nuclear medicine. Think of the people that go through, the people that have been cured from cancer, the people that have been cured from other diseases due to nuclear medicine. Nuclear power, we're going to talk about that later in the program. That all grew out of that effort to build the bomb. Computers. Prior to the computer time, people were calculating things by hand. Computers were used to calculate the direction of artillery fire. And, of course, today everyone carries a smartphone in their pocket, or most people have a smartphone that has tremendous computing power. That technology was, in essence, born, and if not born in World War II, was certainly amplified in World War II. Pfizer was commissioned, along with other companies, to develop penicillin. Up until World War II, penicillin was made in very small quantities, very difficult to make. Pfizer figured out a way to make it and mass produce it. That gave birth to the pharmaceutical industry. And of course, radar, jet planes, all that technology that came out of World War II made a huge difference. And in education, the GIs came home, they went to school. That led to a significant change in our economy. We moved from a manufacturing economy to a service economy. That requires education, and that began in large part with the GI Bill and the GIs going back to work. Home build, coming back from the war, people began to move into homes, buy homes, build homes, gave rise to the housing industry we've seen. And of course, we built the interstate highway systems, we built the airports, and media took an explosive growth. All of that came out of that period of time of World War II. And demographics, life expectancy increased. Women joined the workforce. We doubled our brain power by doing that. And there was an exodus from city centers to the suburbs. Maybe that's reversing today, but at that time, that was happening from following the war. And of course, people moved from the older cities in the Midwest to the West and to the South. So what's going to happen? We're coming out of COVID. We feel there's going to be significant changes in technology. There's going to be significant changes in lifestyles, significant changes in demographics, not just in the United States, but worldwide. And there's going to be ways in which there are opportunities to take advantage of that. I started last week talking about energy. Energy is the largest industry, somewhere between $7 and $10 trillion a year in revenues. It dwarfs something like media, where you're hearing me on the radio, you're going to listen to the radio show, you're going to see TV, you're going to read newspapers, you're going to go to movies, all that, magazines, all books. If you take the entire media industry, it is less than 2 trillion. Energy, 7 to 10 trillion. So I'm taking a couple programs to talk about energy. Last week I talked about solar energy. And I want to take you back to the start of that program because it applies to what I have to say today too. The archaeologists tell us that somewhere between 125,000 and 800,000 years ago, a couple humans figured out if they could rub a couple sticks together, they could make fire. And that was a significant impact. That was a time in which people found that they could gain heat, warmth, they could cook their food, and it gave them light when it got dark. That was over 100,000 years ago, maybe as many as 800,000 years ago. But you know what? 1 out of every 3 people in the world today live essentially the same way. They live without electricity. 1/2 billion rely on primitive fuels like wood and charcoal and animal droppings as their source of energy. 500 million people. Why does that make a difference? Why would we want to know that? Because if you look at the Standard & Poor's 500, half of their revenues come from overseas. Half of their revenues. Half come from the United States, but half come from overseas. If you look at all the companies in the United States, everyone, 43% of the revenues come from overseas. So what's happening worldwide will make a significant difference both in existing companies and companies that are coming up. It's important to understand. It's important to understand water scarcity and major health problems and education. All of that is minimal with those people who live without electricity. So as we move from subsistence to consumption, that makes a big difference in the economy and in the opportunities we'll see. And energy is the most important factor in that change. Energy. That's why I'm spending two sessions on energy to talk about it, where we're going, what's happening, and what the opportunities could be. The estimates are that 93% of the world's population 93% of the world's middle class, not the population, but 93% of the middle class will, by 2030, live in those emerging nations. A lot of them today do not have electricity. They exist and they subsist. I shared this story last week, and I'll share it again this week, about a client that I had who was the plant manager of American Standard in Tianjin, China. And at the time he went in the 80s and into the early 90s, at the time he went, there were 1,000 employees producing ceramic toilets, ceramic bathtubs, ceramic shower stalls. And at the time that plant started up, not a single one of those Chinese employees had ever seen a ceramic toilet or a ceramic bathtub or a ceramic shower stall, let alone used one. That's the way in which 1.5 billion people in this world live. Most have not seen. Today, those people drive cars, they have smartphones, they drink lattes, they buy their clothes in the department store, they get their groceries in the grocery store. They've moved from subsistence to consumption. And it's American companies along with worldwide companies which furnish that. So those are people without electricity. But if you look beyond electricity, if you look, last week I talked about solar, and solar, as I mentioned, can supply up to 40 times the amount of energy required today. And solar's growing at 3% a year. It's only 2% of energy today. But if you look at the compounding effect, in 15 to 18 years, solar power could supply all the electrical needs. But that still leaves 60% of energy that needs to be supplied. 39% needs to be supplied, 29% needs to be supplied for transportation, 31% for offices and buildings and heating your home. Some of that's going to be supplied by nuclear plants, and there are new technologies coming for nuclear plants. The fourth generation nuclear plants, there's going to be faster reactors. They turn nuclear waste into actual energy, and they're using thorium in some of the reactors, which is 4 times as abundant as uranium and less of a problem to get rid of. Don't go away. I'm going to come back. I'm going to talk about new material when I come back. So don't go away. We've got a lot to cover.
About Money with Mike Adams on AM 1590, The Answer. For more information, click on Adams Financial Concepts. About Money with Mike Adams on AM 1590, The Answer. For more information, click on adamsfinancialconcepts.com.
So, welcome back. I've been talking about energy, but I want to take you a ways into the future. Not something that's going to be happening next year. It may be 10 years, maybe it's going to be 50 years. I don't know how long it's going to be, but I do believe that it is possible it's going to be there. So I want to introduce you to this. If you went to school, to high school or college before 1990 or 2000, you probably have never heard of what's referred to as dark matter or dark energy. And yet, dark matter and dark energy make up 85% of the matter in the universe. You know, the radio you're listening to, the chair you're sitting on, the food you eat, the things you buy, those are ordinary matter. That's 15% of the matter in the universe. That means there's 85% of the matter in the universe, which is not something we can see. It's almost invisible. Think about it like our bodies. If you think about the cells our body contains, the bones, the muscles, all the cells that are in our body, if that's all we had in our body, we'd be missing hundreds of thousands of cells, which are almost invisible. Almost invisible. They're the bacteria that make up part of what goes on in our body. If you just think about that, you never even feel that. Unless, of course, you get sick, and then you understand they're there. Like the bacteria, we don't notice billions of dark matter particles which are passing through us every second. It's almost invisible. According to Lisa Randall in her book Dark Matter and Dinosaurs, and Randall is a physicist who proposed that the role of dark matter is one of the reasons why the dinosaurs went extinct, why dinosaurs and millions of other species went extinct. She talks about dark matter because dark matter and dark energy are part of the universe. And why would I be talking about it? Because it's something that is just being explored now. People are beginning to realize that it is part of what makes up the universe. And you can't explain galaxies, you can't explain the expansion of the universe, you can't explain what happened out from the Big Bang that opened the universe unless you can talk about dark energy. The matter we can see, the matter we see, makes up 15% of the universe. But dark matter makes up 85. And how do we know that it exists? Well, if you stand in front of a building, you can't really see what's behind it because light doesn't bend for us. If you have a fish tank, for example, and you shine a light into it, you'll see light actually bend because the matter in that fish tank, that water, will actually cause light to bend. If you wear glasses, and I do wear glasses, light is bent by the way the glasses are formed. Well, as astronomers look into the universe, what they're seeing is something in space where there's no atoms, no actual physical matter, or matter that as we know matter. Their light waves are bent. You can look out into the sky and see what's behind some of the galaxies, some of the stars. We can see around them. And in order to do that, there has to be something out there that is putting a gravitational pull on light waves. And that's what it's been called, are WIMPs. I like the name WIMPs because what those are, it's a weak, and I've got to look up, forgive me about this, I have to look at the name. I don't want to get it wrong. They're weakly interactive massive particles. We haven't seen them, we don't know about them, but we know that they exist because something is causing light rays to bend. That's the WIMPs. And physics is something that it's not like economics. Economics, you have all sorts of explanations and things. One thing may be true at this time, not true at another time. With physics, what's true is true. There's no second, there's no alternative. What's true is true. And I often use Peter Higgs, who in 1964 proposed that there had to be a particle, the boson particle. And he proposed the particle, which was nicknamed the God particle, because physics was built around it. And for 50 years, no one had ever identified or seen the Higgs boson particle. For 50 years, it was a supposition, it was a theory, but it explained what was going on in physics. Had that particle been proven not to exist, all the work that was done in physics for 50 years would have been null and void. But in 2012, at the big accelerator in Switzerland, they found the Higgs boson particle. And that's another story. We'll get into that in another time. But it was proposed, and today the proposal are things like WIMPs, those weak, interactive, massive particles. They exist. The question is, how soon can we begin to harness the energy that they represent? I don't know if that's going to be 5 years or 10 years or 20 years or 50 years. But I strongly believe that it exists out there, and just like we couldn't see bacteria in our bodies, the WIMPs exist as well. That's energy, and that's coming. And that could be very, very significant in furnishing energy. Because as we grow in abundance, as our GDPs grow, as our industries grow, it's going to require more and more and more energy. We want to be sure that we never run out of energy. Anyway, that wraps up our segment on energy. That's been 2 weeks that I've spent on energy. Next week, I think we'll talk about robotics, because I think that's a field that's also coming out of COVID that you'll also want to hear about. But let me now move on to introduce Craig Yan. Craig is one of the new advisors at Adams Financial Concepts. Sharp, smooth, he's got a lot to say, and you want to hear, because listen to him. He will be one of the industry's thought leaders before too long. So with that, I'll introduce Chris.
There we go.
Welcome to the program, Chris.
Thank you. Well, we all know at least one trader in our lives, whether it's the uncle that you see once a year or maybe your aunt. Sometimes it could be a spouse or a sibling, even a friend, but I guarantee you everyone listening to this program knows at least one person that's tried their hand in trading. And if you live under a rock and you don't know anyone in your life that trades, I bet you have at least at one point have gotten an ad from some YouTube guru that's talking about all the money that they have made as they stand in front of their rented plane or yacht, saying that you too could be in their shoes with this simple strategy. What's funny about this person, and insert your trading loved one here, is they engage in the trading for about a year or two and then seemingly stop altogether, or at least they stop bringing it up around the dinner table. Why is this? If I had to bet, it would be from the inevitable. They lost big money on a trade, or they suffered a series of bad trades or losses. So full disclosure, I have never day traded, but I certainly have played my hand in short-term trades that have soured on me. Admittingly, these picks were based 100% off technical tools, and I spent zero time looking at the balance sheet. Sorry, Mike. I am no different, except for the fact that I learned from my mistakes, and I have an open mind enough to seek out, the best strategy. I take hope in that even the best investor of all time, Warren Buffett, was not immune to the allure of technical trading, and he began his young career using technical analysis. Buffett talks about his early childhood, picking up books at the age of 9 and trading his first stock at 11, and then shortly after he becomes enamored with technical calculations with charts and volumes. He even spent the first 8 years of his career using this strategy. I want to say that again. It took the best investor of all time 8 years to realize that his current strategy was useless. Buffett goes on the record saying, "I realized that technical analysis didn't work when I turned the chart upside down and didn't get a different answer," which eventually prompted a very important lesson, one that most traders aren't able to grasp. When you buy a stock, you're not buying a little ticker symbol that bounces around every day. You're buying a part of a business. And when you start to look at stocks this way, everything else will follow suit. So trading is worthwhile, is trading worthwhile if the best investor of all time couldn't do it correctly? Well, that's up to you. Day trading is not worth it for the vast majority of traders. Incidentally, it's been widely estimated that 95% of traders ultimately lose money. And it's been empirically demonstrated that the same percentage of unprofitable day traders continue despite losing money. If you're thinking about day trading for the first time, it's important that you know that trading profits are hard to come by. The paradox of day trading is that it may seem like a good idea, depending on how the stock market is performing. Day trading is essentially a play on the short-term volatility of a stock on any given day. And since we have been, in the longest secular bull market in history, it would make sense that we're seeing more people now than ever resort to this kind of strategy. And maybe they are making some money too, who knows? But remember, rising tides lift all boats. So I've talked pretty high level thus far. Let's get a little bit more granular. A primary reason day trading is a bad idea has to do with the transaction cost. And we're going to come right back to that after the commercial break.
So stay with us. Don't go away. More to come.
About Money with Mike Adams on AM 1590, The Answer. For more information, click on Adams Financial Concepts. About Money continues. Remember the website, adamsfinancialconcepts.com. Here's Mike.
So we're here with Chris. Listen to what he has to say. He is a thought leader. He does have a lot of information. Isn't it positive? So anyway, take it away, Chris.
So up until this point, I'd been pretty high level in my explanation, so I wanted to get a little bit more granular. The primary reason that day trading is a bad idea has to do with the transaction cost. The two most visible transaction costs are taxes and fees, such as trading commissions. If you purchase a stock and sell it before 1 year has passed, then any increase in the stock's value is taxed at your ordinary income tax rate, which is likely significantly higher than the tax rate that would be applied if you had held the stock for a year or more, short versus long-term capital gains. Depending on the trading platform you use and the type of security you're trading, you may also pay commissions every time you buy or sell a stock. these transaction expenses can be very costly for traders and eat away from their net returns. The inherent nature of the capital markets also typically makes day trading a losing proposition. Minute-to-minute stock price movements on any particular day are a little more than random, and they tend to instantaneously adjust to new publicly available information. Further, when you place market orders to buy or sell, you're trading against a large swath of sophisticated institutional investors and high-frequency trading machines. The probability that you know something professional investors do not, without it being illegal insider information, is extremely unlikely. High-frequency trading is based on algorithms. These algorithms monitor multiple exchanges, looking for the smallest discrepancies in stock prices down to the cent. When a discrepancy is found, these machines make thousands of trades in just seconds, profiting off the situation. About 65% of trades today are done so by these machines, often done in dark pools that help the firm stay anonymous and avoid moving the market in a particular security. So if transaction costs, higher tax rate, and fierce competition with algorithms wasn't enough to persuade you to avoid this type of strategy, let me give you another reason. Past performance is not indicative of future results. So how can we expect inputs to predict future trends? One of the key things people get introduced to in technical analysis is indicators and moving averages. There are a variety of these indicators, but what's important to note is these derived lines are lagging. Many individuals that trade, especially the younger traders, have price charts that are encompassed by 5 or 6 derived lines, which are essentially mathematical formulas placed on different points of the price data. But there's nothing predictive about this. But what tends to happen is people begin to make the association psychologically that there's a predictive element, because in hindsight, the graphs are obvious. But in the present, these trends are not easily noticed. They're retrospective. So looking back, you will say, oh, I had this indication right here, right there on the graph, but it's all in hindsight. And at this point in time, you already have new price data. So people get confused and think that, the tail is wagging the dog. The other problem is with indicators is people get into the habit of calling tops and bottoms. So if you use the relative strength index, the RSI, and they say there's a divergence in a particular security, it's not going up as quickly, therefore it's losing some of its momentum, so it's time to sell. But actually, if you had a very violent move up, move in the price upward, like we see in Tesla oftentimes, anything after will look less significant. And we already know that the trends can last for a very long time, yet this young trader has already sold out of the given position. So this is what causes traders to get confused and end up on the wrong side of a trend, ultimately affecting their bottom line and keeping them quiet at dinner. So is day trading gambling or investing? It's fair to say that day trading and gambling are fairly similar. The dictionary definition of gambling is the practice of risking money or other stakes in a game or bet. So when you place a day trade, you're betting that the random price movements of a particular stock will trend in the direction that you want. In the same way that expert poker players study and practice relentlessly to excel at the game, the few successful day traders, who are probably institutions, tend to be extremely well versed in how the markets move in the short term. So if a novice poker player were to challenge a table of experts, he or she may conceivably win, 1 or 2 hands, but would almost certainly lose all the money. While day trading is not precisely the same as gambling, one thing remains true about the practice. Most of the time, it's not profitable. So technical analysis, it involves algorithms, and I will be using these terms synonymously. Algorithms have undoubtedly changed the world. There was once a time in the 1980s when people believed that the computer would never be smart enough to beat a human in chess. Then in the late 1990s, actually 1997, it was an accomplishment for man to beat computer. In just 20 years, our perspective on this dramatically altered. In chess, algorithms work great because there are no surprises. There are over 9 million variations after just 3 moves, and after 4 moves, there are 318 billion ways to play. The key here is there are 318 billion ways to play, not 318 billion plus 1. There's no room for something unexpected. This is why algorithms perform well in game settings. However, capital markets are not a game. We find that our plus 1 situations cause algorithms to fail. Another word for plus 1 in the markets is black swan. Like I talked about earlier, indicators are algorithms based on past price information. The problem is the algorithm can't account for the situations that have never happened before. And as we know, things that have never happened before happen all the time. The market is based off human emotion, sentiment. Human sentiment is constantly changing, and it's impossible to predict. You never know what stimulus response is going to take place in a certain event or situation. Human emotion is impossible to predict. Interestingly enough, in 2020, a black swan year, 12% of algorithms used in funds shut down. Why? Because there's no reliable data on a pandemic. The entire economy had not been previously shut down, where people stopped going into work. Therefore, the algorithm couldn't quantify the situation and operate correctly. These algorithms are designed to operate in stable, consistent markets, just like the game of chess. But when you add the +1, the risk model is thrown off. What I find interesting is that most of these algorithms and technical analysis have been developed in the last 10 to 12 years. Well, since the recession in the bottom, of 2009, we've been in the longest secular bull market in history. So if you're thinking about investing your money, wouldn't you want to see a strategy that's been around long enough to see multiple bear markets? It does not surprise me when you turn on the news and see anchors talking about the latest fund and how they've been able to outperform the market over the last number of months, because most people invested in the market are doing well right now. Again, rising tides lift all boats. So what I would like to see is the tide go out, because when the tide goes out, you can see who's swimming naked and what strategies are still valid. So naturally, I need to bring up an individual who has used technical analysis successfully. While most traders arrive at the party late and leave early in regards to timing the market, Ray Dalio has actually been able to use his algorithm to beat the market. However, according to the California County Pension Fund, one of his clients, they have recently put Ray on notice for lackluster returns, which is contrary to what many people believe about Ray's strategy. Ray's Bridgewater Associates Pure Alpha Fund has returned an annualized 4.5% since about 2005, about 2.5 percentage points less than its benchmark, according to Bloomberg. If you look at the year-to-date numbers or his one-year numbers for the fund, you'll see that they've matched or even outperformed the benchmark. However, like I have already said, it can be very difficult to consistently beat the market using technical analysis. And if someone as bright as Ray, with all the tools at his disposal, it goes to show that a strategy solely based on algorithms is not a winning formula, even when it sounds good on paper. There's always been a difference between academia and how the real world works. Things taught in schools do not always translate to the working world, because what works on paper isn't necessarily reality. From a high level, there probably won't be much pushback to the statement, since most people tend to agree. In universities, most business and finance courses teach you about the modern portfolio theory and efficient market hypothesis. These two foundational theories are rooted in most algorithms. And what I want to focus on is the efficient market hypothesis. There are three parts to this theory: the strong, the semi-strong, and the weak form. The weak form of the efficient market hypothesis assumes that the price of the security reflects all available public market information, but may not reflect new information that is not yet publicly available. I tend to agree with this form. The form that I disagree with is the strong form, which states that prices always reflect the entirety of both public and private information. This includes historical and new or current, as well as inside information. Even information not publicly available to investors, such as private information only known by the CEO, is assumed to be already factored into the company's current stock price. So this theory in my mind sounds omnipresent, almost like God. But despite how efficient the market is at pricing information, common sense can probably rule out this theory. Technical analysis doesn't have its place in security evaluation. However, in my opinion, it should be used only to gain a better insight as to where the stock price is trading. Remember, when you buy a stock, you're not buying a ticker symbol, you're investing in an actual company, like Buffett told us. Fundamentals, great business structure, and a franchise on your market are the best way to evaluate companies. So, like I said, I'm privileged enough to learn from the greats like Buffett, Lynch, Templeton, and even Mike Adams. The key to investing has been passed down by these greats using a very simple strategy: find great companies and hold on to them. All right, Mike.
Well, thank you, Chris. And for the listener, aren't you impressed with what he did, what he's had to say? He is one of the rising stars. It took me years to get to the point where he is at this stage of his career. And he's young. He's going to be around for a long time. He can be an advisor for all of your lifetime. So think about him. Give him a call. He's at Adams Financial Concepts. So you have tremendous possibilities, and he's going to do an extremely good job for decades. Decades and decades. So anyway, very, very intelligent, very, very informative for what he had to say. And that reminds me of what's going on in the industry, because the industry is not that. The industry is looking at different things than understanding how to trade, how not to trade, what to buy, what not to sell. A lot of that is pushed off to specialists, the mutual fund managers, the investment managers. We want to really take care of our clients and do the exceptional work they have. So I want to come back after the commercial break, and we are coming to a commercial break, and talk about some of the aspects, because bigger is not necessarily better, and what we're seeing is that in the industry. And I'll come back to talk about that right after this commercial break. So don't go away. I want to close it out on a very positive note. Hang on. We'll be back.
About Money with Mike Adams on AM 1590, The Answer. For more information, click on Adams Financial Concepts. About Money with Mike Adams on AM 1590, The Answer. For more information, click on adamsfinancialconcepts.com.
So welcome back. And I want to talk about Adams Financial Concepts. I don't do this very often, but I do want to talk about it today. I want to talk about what's going on in the industry, where we stack up in the industry, because we decided to be a small boutique firm. That's a choice we made. We're not trying to be bigger and stronger. We're trying to be better. Bigger is not necessarily better. We want our clients to feel like a big fish in a small pond, not a small fish in a big pond where they get an 800 number to call. And when you call that 800 number, you end up talking to one person who may be a financial advisor, another person who may be a client associate, another person who may be a customer service person. No. We want to have a personal relationship with each one of our clients so that you have a relationship that's 24/7. You can contact the person at any time. It's been something I've been doing for most of my career, but it's really the focus of the firm to continue to do that. We want our customers to feel like they have access to each and every person within the firm. You may have Chris as your advisor, but you should have access to me 24/7. You should have access to Sarah and CJ. We want you to have access to each of the people that are there. And you can ask any question you wish to ask. If you want to know what's going on with a particular investment you've got in your portfolio, you should be able to ask that question directly and not have someone give you the party line, not have someone give you the junk bond answer. You should be able to ask that question, know specifically why you have that in your portfolio. And we want people who will say, at times, I don't know. I will find out for you. We're not trying to blow you away by showing you that we've got deep, strong knowledge. There are things that we don't know. And when we don't know, we'll say we don't know. And we will say we'll find out if it's possible to find out. You know, those are aspects of the firm. It's a conscious building of what we're doing. We intend to continue that into the future. We're not buying other firms. We're not bringing in outside people. We're growing the firm. And I believe it shows. If you look at what's happening in the industry, you know, when I started in 1986, the big firms controlled 90% of the market. Today, it's less than 50%. So I took some numbers. I took some numbers that came out of Investment News and also out of Financial Advisor magazine. The number of advisors from the big firms has actually been decreasing. In registered investment advisors, it's been increasing, but we have some things to say about them as well. If you look, the biggest firm is Merrill Lynch, right? They lost 895 advisors in the first 9 months of 2021. They reached such a point that top management instituted what they called Project Thunder. Project Thunder, to try to understand what's going on with the advisors, because the advisors are saying the leadership is out of touch with what's going on. They're saying the The advisors are saying that the firm is withholding the first 3% of their earnings. They pay that after 20 years or when you retire, but they're withholding 3%. The advisors don't like that. If they earn the money, they should get paid that money. At Merrill Lynch, of course, they're owned by Bank of America, and the advisors are pushed very hard to cross-sell, so that if you have a portfolio of stocks or mutual funds with them, the advisors are pushed to sell mortgages and insurance and all the other products that the bank has. And I think it's interesting to note that only 1 out of 5 of the checking customers at the Bank of America, only 1 out of 5 has a brokerage account with them. They know that those other 4 have other brokerage accounts, but why do they not have an account at Merrill Lynch? Project Thunder. Boom. You know, the advisors are asking for more carrots and fewer sticks. That in itself says something. There's a lot of penalties. If you don't do this, this happens. They want rewards. They want to be incentivized, not discouraged from doing something else. And the advisors are complaining about ever-increasing bureaucracy. It continues to build above, and a lot of the revenues the advisors are bringing in all goes to the bureaucracy. And they come up with marketing plans. People that have never been on the front lines come up with a marketing plan, and if you don't adhere to the marketing plan, they don't want to hear what's wrong with the marketing plan. They want you to implement the marketing plan. And they lock their advisors in with a 2-year non-compete. So if somebody gets discouraged, somebody doesn't want to go, they have a 2-year non-compete clause. We're living in a time in which the work world is changing, where people have learned to work remotely. At Adams Financial Concepts, we understand that there's an advantage to being in the office because of the relationships you have with other people and talking with other people, but there's disadvantages as well. There's the commute time, and there's the constant interruptions that happen. So are we forcing people back to the office? No. We're going to have people come for 2 or 3 days or 5 days, whatever feels comfortable for them. But what we saw during this pandemic was an increase in our productivity. People working independently actually increase their productivity. We want to take advantage of that because we think that also is an indication of what they do for their clients. The problem with Merrill is reached the point that they've decided they're going to recruit from within Merrill. They're going to take tellers and make financial advisors out of tellers. They're going to take some of their secretaries or sales assistants and make advisors out of them, hoping that they will reverse this trend of loss of advisors. Is it going to work? Who knows? For a long time, for 20 or 30 years, my first 20 or 30 years in the business, when Merrill moved, everybody moved along with it. I'm not sure that's going to happen anymore. I think we may have reached the point where people are realizing bigger is not necessarily better. Bigger has its own problems. Even in the fact, think about this. Merrill Lynch was an independent company up until 2008, and then they had to be bought out by Bank of America. Think about that. Merrill Lynch isn't alone. Wells Fargo, of course, they've been going through their own list of problems. They lost 898 of their advisors. That's 3 more than Merrill Lynch lost. But then they had more issues that were more public. Edward Jones lost 328. J.D. Powers did a study of wirehouses, published the information in the Financial Advisor magazine. They found out that the financial advisors at the big wirehouses were twice as dissatisfied with what was going on than were RIA firms. It's a significant problem, and it explains why their market share has dropped from 90% to less than 50%. I think that trend is going to continue. you're going to see more people like Chris who really begin to dominate what's going on. And the clients are going to be better served. You're going to be better served when you have people like Chris taking care of your portfolio and your investments, and not some people on high taking care of it. Believe me, you want to be with the people that are the future, not the past. So I just wanted to point that out. We're building on a conscious level, targeted around the clients we have. So anyway, that wraps us up for today. We'll be back next Saturday to talk about money.
You've been listening to About Money with Mike Adams, a registered investment advisor. If you'd like more information about what you heard today, or about Mike's investment philosophy and strategy, or if you'd like Mike to evaluate your own portfolio, click on adamsfinancialconcepts.com. That's adamsfinancialconcepts.com. The information shared in the preceding program was for educational purposes only, and any investment advice given may not be suitable for all investors. Join us again next Saturday at noon for more About Money with Mike Adams, here on AM 1590. The Answer. The preceding program was sponsored by Adams Financial Concepts.